Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Good afternoon, everyone. My name is Jeff Lewis. I'm a financial advisor here at Savant Wealth Management, and I'm joined by my colleague, Teryn Fitzgerald. Teryn, you want to go say hello?
Hi, thanks, Jeff, for welcoming me in. I'm excited to talk about these retirement strategies and kind of dig into our agenda today.
Yeah, thanks. We got a lot of good topics to go through with you guys today, but really focusing kind of on 5 key themes that we see more so in our day-to-day work and thinking about things of that nature. So as I mentioned, we got 5 key topics with you today. We're going to first start on Social Security. I'm going to turn it over to Teryn at this point, and she's going to kind of dive through the first part of the presentation, and then I'll be back to talk a little bit later on. Go ahead, Teryn.
All right, thanks, Jeff. So one question that comes up quite frequently is, when should I take Social Security when I'm approaching retirement? So we're going to talk about some things to consider when you're looking at that. So many people think they should take Social Security as soon as they retire, or have heard something to that effect of maybe I should delay it. So we hear all sorts of things of when they should take the Social Security benefits. But every year that you do delay taking Social Security benefits past your full retirement age, you do get a bump up of about 8% in your benefit until age 70. So that can be quite attractive to wait. So typically the break-even age for what you need, or how long you need to live for to see the benefit of delaying to 70, is going to be in your early 80s. So that sounds pretty great, right? Let's delay to 70. Most life expectancies is early 80s, so maybe that makes sense. But there are some other factors to consider. So what is your expected life expectancy? Which I know can be tricky because you don't have a crystal ball to know exactly when that's going to happen, nor does any of us. But some things that we can consider with that is, do you have any health issues? What's the longevity in your family? And that can help determine what makes sense for when we're doing some planning around that. Also, what are not only your benefits, but what are your spousal benefits? So what does your spouse have? Do they have an earning record on their own? Will they be qualifying for benefits for themselves? Because when we have 2 benefits to work with, sometimes it's easy enough to have a compromise between the 2 benefits. One spouse files earlier, one spouse files a little bit later. The other question is, do you plan on working even though you're retired? Sometimes people will work in some capacity even past retirement. And the question becomes, how much are you going to make? And if you filed for Social Security benefits, is that going to affect it? Because basically, after full retirement age, you kind of can do whatever you want to do. Social Security is not going to reduce your benefit if you filed. But anytime before full retirement age, if you are earning income, there's an earnings test. So you have to make sure that you're not making more than what that is. It changes a little bit every year, but you have to make sure you're not making more than that, or Social Security can reduce your benefits. You kind of get it back later on, but why file if your benefits are going to be reduced? So that's another consideration. The other question is, do you have benefits from an ex-spouse or a deceased spouse? Because there can be some special planning opportunities that come along with that. But in any case, there are opportunities to maximize the cumulative benefits that you have during your lifetime. So that's what we want to take a look at. All right, so on here, what I like to do is run a break-even analysis just to look through these filing strategies and kind of peel back what's going to make sense for your situation. There's a couple charts here. You can see the left one shows cumulative benefits over your lifetime. And it shows 2 different filing strategies, a primary one and an early one. And it has 2 different life expectancies. And we can play around with this, but this is just an example. But one would be 90 and one would be 95. And it shows the cumulative amount that is earned based on those 2 filing strategies. You can also see on the right that break-even analysis that shows what's the primary strategy versus the early strategy, and when does it break even. In other words, when was it better to delay taking Social Security rather than the early filing strategy? What age did it make sense that you were actually better off? And it shows age 70 and 4 months. So in this situation, we'd likely say, hey, it probably makes sense, unless there's special circumstances, that you would delay and take that primary strategy rather than the early one. But even if this is the plan that we come up with, so sometimes we'll look at this before we're even eligible to file for Social Security, and things happen, you know, legislation comes out and things change of when your retirement age is or whatnot, or there's a health concern at some point, or we have a down market. So we start off with a plan, but it is something we'll check in as you get closer and closer to filing to see if anything has changed from the original plan. But the point is to really just review these options available, develop a plan, but stay flexible in your given situation, because it is rather quite easy to file for Social Security, and you can even say, hey, I wanted to file a couple months earlier, and they'll actually retroactively give you some benefits. So you do have flexibility in when you file, just based on what your given situation is. All righty, so the next strategy we want to take in mind is health insurance. Health insurance is one of the most frequently discussed costs that our retirees are looking at, and there's a good reason for that. Historically, health insurance has increased at a higher pace than core inflation, so inflation for goods and services that we see every day. Inflation for healthcare, which I think we've all seen and experienced, has increased at a much rapid pace. So it is key for retirees to develop a plan to help combat these costs. And we're going to divide this in between Medicare versus, you know, if you were retiring before 65, what that would look like on those costs. So kicking it off with Medicare, at age 65, you are eligible to begin benefits. Sometimes people are still working and they don't want to file, and we'll talk about that in just a bit. But the initial period of enrollment does begin 3 months prior to your birth month at age 65, and then 3 months following it. Some people decide, okay, I have credible insurance, and that word credible insurance is very important. There's some definitions around there, and your employer should help you through that. But you do have to have credible insurance through your employer to be able to delay taking Medicare, because there is a cost associated with Part B. So it is, and you know, it makes sense that some people that have insurance that's credible would want to delay it. But you just need to make sure you are talking through that with your employer. But if you don't have credible insurance and are eligible for Medicare, you will want to file, because there are penalties. Honestly, it's kind of interesting and frustrating, but there are penalties to file for Medicare, or for not filing for Medicare if you were in the enrollment period, and you don't want to have those. So if you did delay past 65 because you did have credible insurance, so you're fine, you don't have those penalties. There is a special enrollment period that you will be eligible for after you retire. So you'll have 8 months to enroll in Part A and B, but this is a tricky thing that sometimes people miss. You will only have 2 months if you're enrolling in C or if you're enrolling in D. Medicare is a bunch of alphabet soup, so you'll just hear a bunch of letters thrown at you during that period of time too. So make sure you're always working with an insurance provider that can really explore all these options with you as well. I think something that also surprises people about Medicare is that it's just not enough. So people are always trying to get to this point in time where you're 65, I'm on Medicare, I'm good. It doesn't cover all the benefits. So a lot of times what you'll have to do is have a supplemental policy, or what we call a Medigap policy, which is aptly named because it's bridging the gaps in Medicare. And that again would be something that you would work with your insurance provider, because there are special requirements around what those policies look like. And then another thing that surprises people are Part B and D premiums are actually based on your income. So they're not free, and there are actually adjustments that happen based on what bracket you're in. And here it is. So here are the different brackets. These do adjust every single year, so you kind of want to keep your eye on them every year. And they're usually kind of in pace with inflation is what you're looking at, but they can be pretty aggressive. If you see the top tier there, you were in that bracket there, which unfortunately these do not match up with tax brackets. So you do have to kind of keep an eye on this as a separate measurement. If you did get to the highest tier, you have an adjustment for just Part B. That's $419 a month, and that's one person. So if you're married, you're usually, you know, filing joint together. So you would have that adjustment per person. So quite expensive. So these are important things that, you know, keep an eye on while you go through planning. So what Medicare does when it comes to IRMA or income-related monthly adjustments amounts is they look at your 2-year prior return. And it's going to help determine what bracket you're in. So if you look at the slideshow, it does say 2022. So for example, if we were looking at Medicare premiums for 2024, it's actually based on your 2022 tax return. So that's also surprising to people because, first of all, it was 2 years ago. It's hard to remember what you did 2 years ago. That could affect these, and they do get readjusted every year because they get the new tax return. But it's something that can surprise people if they did something and they forgot they did it, like a Roth conversion. The other thing that they also happens typically when you're retiring is that could have been a year that you were working. So there is a form called SSA 44, or you can just contact the Social Security office if that's easier. And you can tell them there's actually a loss of income. I was working in 2022, so what you're basing it off of isn't correct. Here's my actual income numbers. And they will make an adjustment to your premiums ahead of time. So you don't have to keep paying those premiums that are higher based on higher income, if that's the case. It's what's called a modified adjustment gross income. So it's not just what your wages were, it's going to include dividends, interest. It's basically everything that's on that first portion of your tax return, IRA distributions, taxable Social Security. All those things go into the calculation of what your income is. So if you are filling out that form or providing them that number, remember that is part of the calculation. All right, so that was the Medicare portion. So if you're retiring at 65 and kind of just seamlessly going into Medicare, that's kind of an easier decision to make. If you are retiring before 65, so you don't have that option of being on Medicare, what do you do next? Well, in that case, it's private insurance, which can be quite costly, or there's some other options that we'll kind of go through in just a second. The average 60-year-old, though, pays about over $1,000 a month for a silver plan, so not even the top tier plan on the marketplace. And this can dramatically increase if you're adding in a spouse or dependent. So it is quite pricey and something that really needs to be considered as you're leading up to retirement if it's before 65. So let's talk about the couple of options here. So first is COBRA. COBRA is the continuation of your employer coverage. So it's it's nice because it's kind of what you're used to already as far as what doctors are in network, what the insurance covers. You're kind of used to what that looks like because it is your employer insurance. But many times this is higher than what you're paying through your payroll because your employer is sharing that cost with you, and that doesn't have to be the same if you're on COBRA. So it can be a little bit more expensive than when you're used to. It also does have time limits to it. So usually it's about 18 months post-employment, but there are some special situations that might extend it to. The second option is if your spouse has healthcare through their plan, they decided to keep working, they have health insurance there, you're eligible to be able to be added to it. If that's the case, that's typically the where we see people going to, because you have, again, the employer sharing some of the costs of those premiums. The third option, and this one's a little tricky, I definitely think if it's something you're exploring, work with a professional because there are different options available here. But healthcare.gov, which is the healthcare marketplace, or people say Obamacare, it provides a marketplace for shopping for insurance. And this is private insurance. And you can shop for different types of plans and look to see who's in network. So it's a very easy tool to use online to be able to look for private insurance. That's where that number of $1,000 a month silver plan came through from, is looking on a marketplace insurance policy. But there are credits out there that can be available, but that's going to be dependent on your income and your household size. So it is possible, and we do see this, is that people are able to have a low enough income that they don't qualify for Medicaid, but it's high enough income that they don't qualify for Medicaid, but low enough where they're actually qualifying for some credits to really, and sometimes dramatically, reduce what those premiums are. So there's planning that can go around that too. And then the next one is sometimes, if you're lucky enough, this isn't that common, but it is something that we do see, especially in universities or things like that, or pensions with unions, that there are retirees that have healthcare plans or healthcare plan through your employer for retirees that are sharing some of the costs that is reduced for you when you retire. And so that can be a great option. Or sometimes people work and they work just enough to have the insurance coverage, or they find a job that's part-time or something that they like to do anyways because they're retired and they want to, you know, keep active, and they'll find something that will also provide some insurance. And then finally, this isn't insurance, but it's health related, is the health savings account. Us financial advisors cannot brag enough, I think, about health savings accounts, just because they're, you know, they could be a triple tax threat, which means that, you know, you get a deduction going in, it grows tax free. And if you use it for a qualified medical expense, it also is tax free when you take out. So that's very, very unique. There's usually some tax coming out somewhere in most accounts. This one, if it's used properly, you won't be paying taxes on it. So it's great. So something I like to say is really plan ahead and save as much as you can into these accounts, because they can be a big benefit for healthcare costs. Generally, they don't pay, or they're not eligible to pay, insurance premiums. There are some exceptions like COBRA, long-term care, but in general, that's not why you're, you know, building this up. It's because out-of-pocket expenses also can be expensive. So now you have a tool to use. And also you can be a little bit more selective, I guess, on what insurance coverage you have. If you go through the marketplace, for instance, perhaps you say, well, I'll have something that doesn't cover as much because I have this big health savings account out there that will help cover the out-of-pocket costs. So you don't have to worry about as much coverage that the insurance plan is giving you. The other great thing about it is typically you can invest it. So it's not only that you put money in, it sits there, you can actually grow it and have it participate in your investment returns over your lifetime as well. All right, so next would be our knowing your numbers. So this is really digging into your financial plan as part of the strategy of retirement. So it's going to be important to put that financial plan together with a professional, because when we fail to plan, we plan to fail. Some key numbers like expected expenses, savings, income will be an important part of this. And I'm going to say everyone's dreaded, you know, word is budget. You're going to create a budget. It's very important to kind of have somewhere to start with all of this. And I know it can be a chore. We, as financial advisors, don't like, well, most of us, Jeff will have to chime in on that, but most of us don't really like to create a budget. It's not the best way to spend your Saturday afternoon. However, it is very important, and it's a starting place, and it's really going to inform a lot of decisions. But keep in mind, you don't have to, you know, go through your statements with a fine-tooth comb, have everything tidied up perfectly. What we're really looking for is what's the average? What's the average monthly expense that you have on non-discretionary expenses like housing and utilities? So things that are not flexible, you have to pay, you know, to keep the lights on, you have to pay for your mortgage, right? And what are also the average expenses for discretionary things like travel and entertainment and going out? Because if there needs to be some, you know, cutbacks, you know where you can, right? So that's a starting place. And then the question becomes, is there anything I'm doing now that might change in retirement? We see people with dependents, kids that are still at home, college expenses, mortgages, and all of these things might be changing in retirement, and you can build that into the plan. But that's the starting point. It's a great starting point for building your financial plan. And then from there, what we want to do is connect where does the money come from to fund these expenses. Right now, it's hopefully through your employment, but in the future, you're going to be paying yourself, right? So it's going to be pension, Social Security, or are there any other resources out there? Or is it from your portfolio, from your 401k investments, from your taxable accounts, from your Roth accounts, cash accounts? And if you have multiple accounts like that, where should you draw from? So all of this is kind of building blocks to be able to review retirement simulations like Monte Carlo results and give you a better picture of how your plan works. So we'll give you kind of an example of that here. All right, so this shows a sample of the Monte Carlo results. So it's pretty exciting to see all those lines there, right? But this is using a person's sources of income, so it's very personalized. It's not just, I mean, these can be great, but those standard calculators that you see online, this is really building a custom plan for somebody. and looking at their income, their assets, their goals over their lifetime. And what it does is it runs a simulation of 1,000 different trials over that person's lifetime with different returns every single year, because the variable is, what's the market going to do every year? Returns don't look the same every year, right? So we do that 1,000 different times with different returns every year. And then it shows the end result of how many trials or simulations were actually successful during your lifetime. Success means your plan that is personalized to you with your own assets, income, expenses, etc. Success would be, did it run out of money during your lifetime, or were you able to satisfy all the goals, right? So in the example here, there are 870 successes out of those 1,000 trials. And this indicates that 87% of the time, the plan was successful, which is a great place. If you're working with your financial advisor on this, this would be an A situation here. So this is a pretty confident plan with a 87% probability of success. And that's going to be within the metrics that we want to see that retirees are at. After this Monte Carlo is ran, you can actually play around with it a little bit. So you can have these different levers basically of what happens if I increase my budget. What if I was wrong, right? What if I should have went through the fine-tooth comb, or I didn't realize I do eat out more than I thought. So what happens if that's the case? So you can say, well, if I spend $1,000 a month, those successes go down. If I spend, or maybe they go up, or if I spend less, it goes up. You can kind of play around, so you don't have to have an exact number of how much you can spend during retirement. You have, kind of an idea, right? Because we don't typically spend the same exact thing every month. So really the point of this exercise is just giving you a reasonable, guide to what your personal situation is, and also figuring out if there is something you can do today. Can you work a little bit longer? Can you save a little bit more? Can you spend a little less? These are all things that would help improve the plan and are very personal. We hear different answers to those questions. Some people are like, I'll work tomorrow, or I'll work as long as possible. Other people are, I don't care how much I spend, I need to retire tomorrow. So there is a range there, and you have to figure out what's really important to you, and we can build it from there. So things change over time too. We do recognize that, but this is going to give you a roadmap into, knowing your numbers and knowing what's available for you during retirement. The next number, I said budget earlier, now I'm saying taxes. So another favorite word is taxes. So the next number that you do want to focus on is your tax situation. You don't have to be a CPA, you don't have to be a tax expert, but it is important to know that you're retiring, your taxes likely will change, not always, but likely will. And now you're paying yourself. So it's a little bit of a different situation, because it's important to understand, well, Jeff will talk about some of the different tax buckets, but if I take from the 401k, that's going to look different on my return than if I take from my Roth, but there's pros and cons to that. So it is important just so that you know, and don't inadvertently, increase your Medicare premiums or something like that, because you took from a bucket that has a different tax consequence than another one. So it's important to know what those different account types are, so you can really make a difference in your tax situation. Tax brackets, like I said, are a fun planning thing, but and they're not lined up properly with the Medicare premium. So you're gonna have to look at two different numbers like that at that point. But there are things like Roth conversions that can be considered, because you might be in a lower tax bracket and you might want to have some more money in Roth. Or you might be looking at the healthcare exchange and saying, hey, if my income was down this amount, I would be able to get this much in premiums as a credit, or credit towards my premiums, and that might be a solution for you too. So that's why those brackets are important, is to kind of consider the Medicare brackets, consider your marginal income tax brackets, and capital gain rates as well. And I'll show you in just a second, because you should be able to work with a professional that can give you that key data. The final thing that I want to kind of mention too is that when we're working, we're withholding from our wages, right? So a lot of times we don't really think about the fact that we're paying into the IRS automatically. And that's a little bit different when you're starting to pay for yourself. Depending on, where you're withdrawing from, sometimes you can withhold taxes, but it's your decision at that point. So it's a little bit different than someone making a decision for you. Should you withhold 12% taxes? Should you withhold 24% taxes? Those are some things that you'll have to look at together again with your financial professional, just so that you can withhold enough, or you can make estimated tax payments to the IRS. Sometimes that's different from, again, when you're working, you're not used to that, but they can guide you on how to do it. It's relatively simple. All right, so this is an example of what a financial professional can provide you with. Is just a tax report with some key numbers here to answer some of those questions. So again, you don't have to be a tax expert. You can just know, okay, for this example, I'm probably going to be in the 12% tax bracket. What does that mean to me? How far away am I from the next tax bracket? So when you're looking at withdrawing, that can be kind of important, just because if you take out, in this person's scenario, if you take out another 50,000, you will be bumping up to the next tax bracket. So it's more just to kind of have an idea of how these things affect each other, so that if you're making decisions like that, you're aware of what the consequences are. It also provides this tax report, for instance, things like what your capital gain rates are. So this person on the bottom of the page, they are actually taxed at 0% capital gain rate. So when they're going to sell things in their taxable accounts, the gains in there are being taxed at 0%. So right now that's a good place to take money for if you wanted to save some taxes. There's another part to this report that we didn't share, but it does show those Medicare brackets as well, and kind of gives you that you are here, so you know how far you are from another bracket as well. All right, so knowing your numbers, that's the tax report, that's those financial planning, that's that budgeting. Very important part of building into retirement, because just having that expectation of this is what my tax plan is, this is what I can spend, this is my financial plan. That knowledge is really comforting when you're heading into something that's unknown, like retirement. Many people haven't done it before, so when they're doing it, it's the first time they're doing it. And so these types of things can really give you a sense of confidence and expectations of what you're able to do in your retirement. And with that, you get to hear Jeff talk instead and talk about investments.
Yeah, thanks, Teryn. For the record, budgeting, I'll probably get slapped on the wrist here by some colleagues, but yeah, budgeting, just a tough exercise to go through. Not how I like to spend my Saturdays either. There's different ways I think that make it slightly more enjoyable to go through that exercise, but certainly overall not where I want to be spending my Saturday mornings. So in terms of getting the question around how do I optimize investments for my retirement, when do I start thinking about making changes based on how much longer I'm continuing to work? I think there's a lot of things that people begin to think about when it comes to retirement, Social Security being one, planning for Medicare being another, but then recreating your paycheck, now that you're not going to be working anymore. But then one of those common questions is, well, how do I structure the investments to really be best positioned going forward from here? And I think the biggest starting point, or the biggest I think rock that gets in people's way when they first start making these decisions is, over the course of life, you accumulate money. You may have an account here, an account there. Maybe you got one advisor there, one advisor there. So you come to retirement. Now it's like, all right, I got all of these accounts and they're kind of spread out everywhere. Well, what does all this mean to me? And so like the opportunity to really ask yourself the question, is it now time for me to start thinking about making this a little bit more simpler? Do I need to start consolidating this so I can manage this a little bit easier, where I don't have an account at E-Trade and Schwab and Vanguard, and I have a Robinhood account, and then I have 2 different advisors that I'm working with? Like, to me, that adds a lot of additional complexity that a lot of people just don't need. And so I think it first starts with, number one, like, am I now to the point in life where I need to like simplify via consolidation? So that's the first question that I generally ask individuals. And then from there, that's when you start really building out more of the strategy piece. So you think about like the asset allocation, the mix of stocks, bonds, and alternative investments you should own. There's those old rules out there that it's like 100 and minus your age, and that's how much you should have in stocks. There was a time and a place for that, but longevity, now people living in their mid 80s, I just don't think that formula is really a great formula going forward anymore. So for the do-it-yourselfers out there who are doing some of those online calculators that are telling you take 100 minus your age or 110 minus your age, I would just be careful with some of that. But then obviously, taxes is integrated in every decision that you make and that you will make once you are retired. And so structuring it in a way where it's, okay, how am I minimizing tax burden today, but also going forward, I think is huge. And, for the most part, most CPAs, accountants are really, really good at, preparing your 1040, preparing your tax return for a specific year, saying, hey, this is how much you owe, this is how much, you're getting as a refund. But it's all like 1 year in reverse. They're always looking back to the previous year. Proactively planning going forward is a big part of what your retirement's going to be from an overall tax impact. So making sure that you're taking that into account. And then obviously planning intergenerationally between yourself, your kids, or your grandkids, how you structure your investments if leaving an inheritance is important to you, how you structure your investments if leaving an inheritance is not important at all. Like, there's different ends of the spectrum. And I think it's definitely important to recognize that not everybody falls on one end or the other. And then there's everybody in between in that regard. So these are kind of the things that, I'm thinking about, when having those types of conversations. So when we kind of look at a portfolio of your more traditional investors portfolio who's been saving to their 401k all these years, typically they've got some sort of S&P 500 fund, like a US large stock fund, and then they may have gravitated over the years to more of a 80-20, 70-30, 60-40 mix, just depending on where they're at. And I think that's okay. I mean, I think for a lot of people, there's a lot of benefits to keep it simple, invest in things that I understand. But I think maybe potentially one of the short-sighted effects of this is you're missing out on a much larger global opportunity set. And so, by sticking to the things that and the things that you're most comfortable with, I mean, that's human nature. I mean, we all fall victim to that. Myself, Teryn, we all fall victim to that. And so I think this is where, when we think about, different diversification benefits and factoring in different factors, Teryn, if you head to the next slide, when we think about, diversifying in different ways, there's really 4 strategies or overlays that you can do within a portfolio to potentially build out more diversification. And the main reason for diversifying is, one, to help lower the overall risk of the portfolio, because I think when you think about it, our current CEO, Brent Verdesky, has this saying, you want things to zig when others are zagging, and you want them to be able to balance off one another, because at any point in time over the course of the year, there's going to be the best possible investment, there's going to be the worst possible investment, and then there's going to be everything in between. And identifying what the best possible investment or the worst possible investment is for any particular year is anybody's guess. So how do you protect yourself against being the big loser or getting lucky and being at the top? Well, you own everything. So you think about the 4 different strategies: enhancing more of a diversified bond portfolio, investing more globally outside of the United States, where you have companies that are domiciled in different parts of the world, whether that be South America, Western Europe, Asia, Africa, having exposure to those different parts of the world, and then tilting towards different factors like value companies that tend to pay higher dividends, and then smaller companies that tend to outperform just because they're at a little bit of a smaller growth cycle based on where they're at in their business cycle. And then lastly, and this has become more prevalent, I think, in the last probably 5 to 7 years, I would say, because we were going into a low interest rate environment with bonds. So people were seeking return in other ways. And that's where alternative investments really played a huge part in building out a more diversified portfolio from that nature. So I think when you put all of this together and you overlay the different diversifying strategies, what you get is a portfolio comprised of 22 different asset classes that you are now invested in. Remember, the portfolio that we started with was kind of 3 asset classes. Just by layering kind of 4 different key diversification strategies, you now have much more diversification within the portfolio, which, the benefits of that is potential less downside risk. And obviously it doesn't protect you in full because there's no guaranteed when it comes to investing. In order to earn return, you have to be willing to take a little bit of risk. And I think optimizing and finding that right risk return profile for each individual investor at the foundation of all financial plans is kind of the number one important decision. But then from there, you don't want to overthink it, right? So it's not something where you're checking it daily, you're actively making trades based on what the market's doing on a daily basis. That asset allocation decision is really based on what Teryn was talking about earlier and how it relates back to your financial plan. So like, what is the rate of return that is required to make your financial plan work, where you're able to do all the travel or all the volunteer or all the family gifting that your heart aspires to do? How do I make all of that work? Because really, that's the most important question. That's what I would argue, and I'm sure Teryn would argue it as well. It's not necessarily, did bonds return 5%? Did the S&P return 11%? That's all good information, but what does it really mean to you? And it all comes back to the values and the goals and the priorities that you have in that regard. So Teryn touched on this a little bit, and this is kind of when I think about the optimizing your investments, this is definitely more the tax piece of things. So we talked about kind of the asset allocation strategy, how you overlay a portfolio of stocks, bonds, and alternatives. Now it's, okay, well, how, from a tax perspective, knowing that every decision that I make going forward is integrated in taxes, how do I think about this? And so there's kind of 3 different buckets that you have potentially when you're retired for the most part. There's the first bucket is your taxable buckets. This could be an individual account, a joint account that you own with a spouse or a family member. This is a category of like a revocable living trust. These accounts are subject to what we call preferential capital gains treatment, assuming the investments are held for greater than 365 days. So when you buy $50,000 of Apple stock and then you hold it for 10 years, and now that $50,000 is worth $100,000 and you sell that position, only $50,000 of that $100,000 is subject to taxation, because the other 50 was just basically what you call your basis of what you originally put in. Interest in dividends on an annual basis flow through to your income tax return. So you think about on your 1040 where you have to report dividends and interest. If you have this type of account, the dividends and interest that are generated in that account are going to flow through into your income tax return every year. The second bucket is kind of like your pre-tax bucket. This is your traditional 401k, IRAs. This is mainly where most people's wealth is concentrated, where they've been saving for the better part of their working careers. In this bucket, basically, remember, you've been putting money in along the way. And because of that, you've been receiving a tax deduction, hence the word pre-tax. So you've been getting a deduction from your income all of these years. Oops, sorry. Just had a camera malfunction. We're back. We're here. We're good. So remember, you've been putting monies into that account pre-tax, and you've been receiving a deduction from your income. Well, now when you take those monies out, now the federal government's going to require that you start paying income tax on those dollars. So every dollar that comes out of that account going forward is taxed at ordinary income tax rates, which are the highest tax rates in our tax code today. So when you think about dividends and interest and gains within this type of account, doesn't show on your tax return in any given year unless you were to take a distribution from this account. So once you start taking distributions from this account, that's where it flows into your tax return. And then the third most desirable bucket that I think most people probably are trying to get more and more money in these days is the Roth bucket. How do I get more money into this tax-free bucket of money where once it's there, it's never subject to tax Because you think about, as you save towards a Roth IRA, this is after tax money, monies that have already been subject to taxation on the federal government side. You're contributing it, and then from there on out, it grows tax-free. And as long as you access it, in most cases, after 59 and a half, in most cases, you're gonna be able to access that income tax-free. So having different amounts of money in each of these three buckets, I always say, provides you a nice little layer of tax diversification. We talk about diversification by investing in different things around the world. You also want to be diversified from a tax perspective as well, because you don't want to be in a situation where you're subject to a certain tax law that changes in an unfavorable way to you, and now you're stuck. There's not really anything. So working towards building out more, different tax buckets is important. Finally, kind of the last thing that we think about, and this has changed more so in the last couple of years, I would say more so in the last 5 to 7, is how do you find fulfillment in retirement? Because we can talk about all the dollars and the cents, but unless you're retiring to something, unless you have a set plan for where you're going to spend your time going forward, unfortunately, you could be feeling a little unfulfilled in that regard. Because you think about it, you've been working for 40 years, 30, 40 years, and now you have to fill all of that time with something. So, Teryn, I'd love to hear your thoughts on this as well. I think this is something where at the center of a lot of discussions that we have, it's what's next for you, what's most important, and how do we get there? So, Teryn, I invite you to chime in here as well, just to kind of share your opinion on this.
Yeah, it's interesting because I think we are all working towards that goal of retirement, and rarely we stop and think what that means after that happens. So we are fortunate to work with people or know people that have retired and get to see that every day, and what works, what doesn't work. Obviously that's based on personality and values, but it really is such a shift in mindset that it's very interesting. It's something that we talk about all the numbers and all the finance and the taxes, and that's great. But really, this is kind of the key to all of it, is because you want to be happy. You want to spend your time and feel fulfilled. And rarely are people thinking about that while they're working towards this goal. And I guess the other thing I would say is that it's this mentality shift of save, save, save versus, wow, I can actually touch the money that I just saved my whole life for, and that feels wrong. Like you told yourself all this time, like that's wrong, right? And so I think that is such a hard thing it takes years, to be honest. And then it's totally opposite, but it's like, I'm having a great time. But those first few years, it's very difficult, I think, because again, it hasn't been something they thought about. They really focused on just the savings. And then they're telling themselves, I can touch something that I told myself not to. And what I was working for, the reward is now here, and I have to change my attitude about it. Is that what you're also experiencing, Jeff?
Yeah, I mean, retire to something. That's like the one piece of advice that I give people, because just by trade. So I'm sure there's probably some people on the call. Like I'm a big golfer, and some people say like, well, I'll just golf like every day. Like that sounds good, and it's just sometimes like you can't golf every day, right? Like you got to have something else to provide that satisfaction or that fulfillment that work was providing you, whether it's just engaging with other people, staying in touch with family, doing travel personally for yourself, volunteering in your local community. I think all of those things, it's generally, the answer is it's a combination of a lot of that. It's not one specific thing. And I think it's based uniquely always on the individual and what's most important to them. So very important discussion to have, because too many times, we potentially see scenarios of somebody not retiring to something, and they're like, oh, well, this isn't what I thought it was going to be. Like, what do I do now? So trying to avoid that and trying to have those upfront, honest conversations upfront before it happens, I think is really beneficial. I know we're coming up on time here. We've got quite a few questions in the Q&A as well.
I was just going to mention too, with this too, is one thing that we have seen a lot more of too, is people working a little bit and sidestep or stepping down gradually to retirement rather than just doing it all at once. So that can kind of gear you up mentally for it too, rather than just one day never work again. So that's a little tip if you can do it that way. I think it does seem to make people's transition a little smoother.
Yeah, good point. Yeah, good point, Teryn. Good point. So just based on the number of questions that we have in here, we're not going to be able to get to all the questions today. However, there will be a link. If you have specific questions regarding your situation, there's going to be a link that gets put in the chat. If you'd like to schedule a time to talk with us or discuss more personally kind of your situation, feel free to use that link that's in there. Otherwise, we're going to jump into the Q&A because I know we've got quite a few questions. And that's actually a good transition, Teryn, based on the last comment you said. One of the first questions that came through is, how common is it for people to work part-time for a few years going into retirement? And I think that's actually the new way of retirement. This has been more of a trend in the last 5 to 7 years where people are trying to stay somewhat engaged, but kind of ease their way into retirement. And quite honestly, it works really well for a lot of people because it does provide them that transition of, okay, I was 40 hours a week. Now maybe I'm 20 to 25 and I'm lightly doing more projects that I love as opposed to, all the other stuff that comes with a 40-hour work week. Now they're kind of able to dictate some of the terms of, when they're going to work and what they're going to work on, which is nice. So if you have the flexibility to do that, potentially encourage you to pursue that option going forward, because it's a tight labor market and employers are still having a hard time finding people to hire for certain roles. So if hanging around part-time on a part-time basis is something that might resonate with you, would certainly encourage you to do that. Teryn, one of the other questions that came in specifically around Social Security. How can I know my Social Security benefits from my ex-spouse?
Okay, good question. So now, sometimes we have relationships with our ex-spouse that we're in contact, and sometimes we don't. But the good news is, no matter the situation, you don't have to contact your ex-spouse to say, did you file for Social Security benefits? They are totally out of the equation when it comes to an ex-spousal benefit. So you don't really have to contact them, and they don't have to file yet. So it's really purely, it's a little unique because usually as a couple that's married, you're making this decision kind of together. And it is important if one filed and you're taking spousal benefits. This is a little bit different with ex-spouses. I think they kind of recognize that not everybody is, on speaking terms or with their ex-spouses. So this is a way to do that. So basically, though, if you do know their Social Security number, you might be able to just log on to your the website, the socialsecurity.gov website. If you have a profile there, you can and look at the benefit. And people are surprised by this. The Social Security office can be very helpful. We've had a lot of people tell us they've had great experiences with talking to their local Social Security office, and they can help and guide you into getting what those benefits are. So give them a call, and they can provide you with those options as well.
Gosh, a lot of Medicare or Social Security questions. So obviously, Teryn, you are definitely the more interesting of the two of us. So kudos to you on that. What's the difference between Medicare and Medicare Advantage?
Okay, yes, good catch. I didn't really get into that. I think we've had a webinar on Medicare because it's just so much that you can cover on that. So I didn't really talk about Medicare Advantage plans, which are kind of like bundled plans. So I mentioned Medicare, original Medicare is alphabet soup. You have to know A, B, C, D, all the great stuff, supplemental. And so instead, that's still the place in there. It's still part of Medicare Advantage, but it's more bundled together. And there is advantages and disadvantages to both. So it's really, like everything else, a personal decision on what you're looking for when you're looking for your plan. There's a lot of specialists in Medicare. We can help out with that as well, to kind of determine some factors that might go into the decision of going towards Medicare Advantage versus just original Medicare with a Medigap policy. One big factor would be, in-network doctors versus not having or out-of-network doctors. Usually Medicare Advantage plans are a little bit more limited than that. So that can be the big difference there. If you're, really interested or need a specialist of some sort, you might go in one way. But that's just one of many of why you would go one way or the other.
Yeah, I got one more Social Security question because I think this is a very common question. So I want to make sure we answer this. Given the current state of the funding of the Social Security Trust Fund, how does this impact, filing Social Security earlier versus waiting and delaying benefits to potentially where the trust fund is no longer solvent? I think very good question. There's a lot to this. When I think about this, there's a lot of legislative risk associated with this. I mean, you think about the governing bodies that will actually govern the process of making changes to Social Security. You think about the executive branch and the legislative branch, Congress, they're going to have to come to some sort of agreement on what's the best way to fund this going forward. I think the last update that I saw was 2035, roughly, is when Social Security is set to have more benefits being paid out than what's coming in tax revenue. Now, that doesn't mean that the program is insolvent at that point. It just means it's running at a deficit. The answer that nobody wants to hear, but is quite honestly probably the most likely, is tax rates probably either have to go up or they have to start eliminating certain thresholds for like how much earnings are subject to Social Security tax. So like right now, I forget the official dollar amount. Teryn, maybe it's roughly the first $160,000 of your wages are subject to Social Security tax. Wages above and beyond that amount are not subject to Social Security tax. That's probably the easiest lever for them to pull to make Social Security trust funds more solvent. In order to do that, you're going to have to get both sides of the aisle to agree in Washington. But going back to the original question, how do you navigate this? I think it comes back to your personal need, right? So like it comes back to your need for cash flow. Do you have other potential personal savings to help bridge the gap between 62 to 67, where your full retirement age may be? Because generally speaking, people are living longer. Advancements in medical technology are advancing at a rate that I don't think a lot of us can truly still comprehend. And so because of that, people are likely to live longer. So deferring benefits still could make sense. It doesn't make sense for everybody. But I wouldn't necessarily go file for Social Security benefits based on an article you read about the trust fund running out of money. I don't think that's necessarily a good strategy either.
And I'll just add to that a little bit too. I think it depends on where you're at. So for the generation that's just started working, maybe when we're looking at financial planning or savings, we don't factor that in as much, right? But if you're pretty close to filing, that's kind of being factored into some of these budget issues too, as these are the new retirees that are coming in filing. So you probably have a better chance that what's stated is what's going to be there for you is going to be there than perhaps a younger generation. So the planning might just be, or the advice or how much we factor it in might be just where you're at on filing.
Good point, Terry. Good point. Obviously, really appreciate the time that you take out of your days to come and listen to us. If you have any questions, like I said, there's a link in the chat that you can use to schedule time with Savant to help further discuss kind of your individual needs. But if you have other questions, feel free to reach out as well. So just want to thank you all for coming again today. Really appreciate it. And have a good rest of your day.
Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.